Bags! Hey gang, I'm Dr. Who. This is Accounting is a Joke, where accounting makes sense so you can make dollars. Today we're going to take a look at a walkthrough problem on how to properly identify adjusted entries. So without any further ado, let's get it. Gang, we are now into the adjusting process. And basically the adjusting process allows us to adjust the accounts before they are creating the particular financial statements. Certain accounts must be adjusted accurately before they reach the financial statements because those particular accounts will either be overstated or understated. Now, I want to give you a quick introduction of the 5 basic adjusted entries that we deal with. We deal with prepaid expenses, we deal with depreciation, we deal with accrued revenues, accrued expenses, and unearned revenues. Now, quick description of each. Prepaid expenses are assets that are created anytime you pay for an expense in advance. Advance meaning the expense hasn't incurred or happened yet. An example of a prepaid would be to pay for rent 12 months in advance before the rent is actually due. Rent being an expense means that it hasn't incurred yet. We're paying in advance, which makes it an asset to the company. Now, as time goes on, that particular asset goes down, which makes it adjustable because the rent expense is going up. So, from that particular standpoint, prepaid expenses are also known as deferred expenses. In contrast to a prepaid expense, we also have unearned revenues. Now, unearned revenues aren't technically revenues. Why? Because they are created anytime a company receives cash in advance for a service to be provided in the future. So what happens is the company receives cash but hasn't provided that particular service yet, which thus means that the revenues haven't been earned, i.e. unearned revenue. Since the revenues haven't been provided yet or earned, the company still owes. So with that being said, unearned revenues aren't revenues, they're liabilities, gang. And so what happens is, as time goes on and the company is providing that service, those liabilities should go down. And why those liabilities are going down? They're going down because revenues are being earned, thus increasing our revenues. Unearned revenues are also known as deferred revenues. Depreciation is an adjusted entry which basically tells us that we are going to record an expense for a long-term assets that's been used throughout the period, which value should go down due to wear and tear. Accrued revenues are simply revenues that have been earned, but they haven't received the cash for them yet, thus creating a receivable. Accrued expenses are expenses that have happened, but the company hasn't paid for them yet, thus creating a payable. And so that's a quick synopsis of the 5 basic adjusted entries. If you want further detail, I'll drop a link to a video that'll get you up to speed. So now that we have that out the way, let's get to the problem. It tells us that for each transaction, identify what type of adjusted entry would be needed. Select from the following 4 types of adjusted entries: deferred expenses, also known as prepaid expenses; deferred revenues, also known as unearned revenues; accrued expenses, and accrued revenue. Easy breezy, gang. So let's see the first one. April 1st, paid 6 months of rent, $4,800. Key words: paid 6 months of rent. So, gang, what happened? This particular situation, the rent was paid in advance, 6 months of rent. Since rent is an expense and it hasn't happened yet, however, it was paid for, we have an example of a prepaid expense. So we know that prepaid expenses are also considered deferred expenses. So this is an example of a deferred expense. Moving on. April 10th, received $1,200 from a customer for 6 months service contract that begins on April 1st. So we received $1,200 for a 6 month service contract that begins on April 1st. So we received cash in advance for some services to be provided in the future. This is an example, gang, of an unearned revenue. We also know that unearned revenues are also known as to be called deferred revenues. So anytime a company receives cash in advance and services are expected to be provided in the future, a liability is created. So this is an example of a deferred revenue. Next, purchase a computer for $1,000. Gain. This particular computer that we are purchasing, we're going to consider that to be a long-term asset. Why? Because we expect to use it longer than a year. Now, as time goes on, this asset's value, because we're using it up, should be depreciated. Now, when we're talking about depreciation, we're simply referring to that this particular asset value must go down. And as that value goes down, an expense is being created. So, from this particular perspective, we have an expense that hasn't happened yet, even though we purchased this asset. So we're going to consider this example to be a deferred expense. Next, purchase $300 of office supplies on the account. So this is yet another example of purchasing supplies on account, purchasing an asset but creating a liability. The unique thing about these supplies, gang, is that we purchase supplies as an asset, but as we use these supplies up, we record an expense. We debit supplies expense every time we are using up our supplies. So the fact that we purchased this particular asset and the expense for using up this asset hasn't been created yet, we're going to consider this to be an example of a deferred expense. Next, work performed but not yet billed to the customer. Keywords: work performed, not yet billed. So in this example, we provided the service, however, we didn't receive the cash. Now based on the previous explanation of what an accrued revenue is, this fits the bill, gang. Accrued revenues occur whenever revenues are earned, but they haven't received the cash for it yet, which means we have to set up an account receivable. So since this work was performed but hasn't been billed yet, this fits the proper entry. So we're going to consider this transaction to be an accrued revenue. And last but not least, gang, employees earn $600 in salaries that will be paid in May. We are now in April. Keywords: salaries paid in May. So what example is this? We know at this level, salaries is an expense, and this expense has happened, which means we must record it. However, we are not going to pay on this expense until May. So what does that make this? A perfect example of an accrued expense. By definition, accrued expenses are expenses that have happened or incurred, but they haven't been paid. And so this fits the bill perfectly as an accrued expense. So we're going to check the answers on all of these. Fantastic, gang. So there you have it. A beautiful illustration to set the tone on us further explaining what are accrued expenses, accrued revenues, depreciation, unearned revenues, and prepaids. If that light bulb clicked and you're further closer to chasing the bag by understanding accounting, please like, subscribe, and share the channel with your friends. Don't be stingy. As always, gang, I'm Dr. Who, and I enjoy you guys sharing your time with me, and I'll see you soon. Thanks.